I'm Teneale.
And I'm Kelsey, and we're financial advisors from 𝐴𝑙𝑚𝑎𝑛 Partners True Wealth, bringing you thought-provoking conversations around you, your money and your life on the Wealth Experience podcast. Welcome back to Wealth Experience podcast, and today we're going to be talking about the concepts of paying down debt and saving cash, particularly in an environment where interest rates are increasing and as is the cost of living. So some of the dilemmas that we're seeing is people are thinking, well, do I save more cash because we don't know where the future is heading, or do I really start focusing on paying down my debts because the interest rates are increasing and it's becoming a bit of a burden and a little bit scary perhaps. So the purpose of today's podcast is to provide a little bit of insight and some tips on how to save money in this type of environment, and if that's actually right for you to be doing, or if you should be paying down debt. And certainly it's not personal advice or tailored to anyone's circumstances, but more of a generalised view around, some of the things to start thinking about. So Teneale, let's wind it back and talk about some of the basic concepts around the purpose of the cash and benefits there.
Absolutely. Well, first of all, when we're talking about cash, that can mean different things to different people. When we're talking about cash, in reality, we're talking about money in the bank here. We're not talking about dollar bills that you keep under the pillow or in that locked jar somewhere. We're talking about money in the bank.
Do people still do that?
Yeah, I definitely get those questions a lot about, should I be putting my money under the pillow? And it's a great question, right? Because the idea of having this store of funds available, and it's kind of like flight money, I want to call it. I feel comfortable because I've got this money that's there, so that when the rest of the world goes kaboom, which seems to be a lot of people's opinion, that I've got something that's accessible and it's ready to go, and I can afford to barter for a bit of food or whatever the case may be.
Yeah.
What that really does is it puts me at risk for inflation. And inflation is the rising cost of living. And so I think cash is king, right? We talk a lot about cash being king. I need to have money. I need it readily accessible to me to do the things that I want to do. But I need to understand that risk factor, that inflation factor, that increasing cost of living. In more recent months and years, we've seen inflation at extremely high levels. So we've seen them at 6 and 7%, where the long-term average might be somewhere around 2.5% and 3%. So with rising inflation, that increasing cost of living, what we're really talking about is if I was to buy a loaf of bread, 10 years ago, it might have cost me $1. $2, and now it might be costing me $5 or $6. Or if you have to buy gluten-free bread like I need to for my son, it's $7.50 for a loaf, and that's a hard pill to swallow. Mm-hmm. But inflation just really means that the economy is continuing to move ahead. So we're making more and more money, and therefore the goods and services that we're paying for are more expensive today than where they were previously. This can be particularly hard for money that's in the bank, though, because if inflation is running at a high level, 5, 6, 7%, and my money in the bank has traditionally, over the more recent years, been earning 0, 1%, it's actually going backwards in real terms. So my money at the bank tomorrow is worth less than what it was today in a period where inflation is running at higher rates than what interest is paying me on that money.
Yeah. So really it's good for people to start thinking about, well, how much cash do I actually need to be in the bank, and what's the purpose of this? And this can be really difficult because really it should be your emergency funds, right, that you want to access at any point in time for those just in case moments. And that's different for everybody depending on your circumstances.
Yeah, I was just going to ask you how much is emergency funds is right? How much do you have is usually the question, right?
Yeah, exactly right. Or, how much do you see other people keep in emergency funds? And really it has to come down to your own personal decision. So you can't really give too much direction on what that should be, but just think about, what's going to be a little bit too much perhaps.
Yeah.
Because just like you're saying with those risks of inflation and your money not working hard for you, and that's probably the balance between, do we keep more cash or do we pay down our debt? I think first of all, you've got to make sure that your cash reserves are catered for.
Yeah.
That's really important. And then perhaps anything in addition to that can start adding to either your lifestyle, your debt repayment, your goal funding, all of those sorts of things. So
yeah, and I think in there too, how much is right for one person and another is completely different, but there are different factors that will dictate how much needs to be readily available. So if I have two people and they're the same age and they earn the same amount of income and have the same amount of living expenses, but one of them has income protection and the other doesn't.
Good point.
You know, I would expect that you don't need to hold as much in reserve for things like, I don't have a job tomorrow because I've had an injury and I've broken my leg playing soccer. If I've got some income protection in place, or conversely, if I have young kids and I don't have private health insurance or something like that in place, I might want a higher level of reserves. But you're absolutely right. How much is too much to have in the bank account then?
Well, I think if we're speaking absolute maximum level, I think we have to think about what is the government going to cover you for in the first instance. So if you've got any more than $250,000 in cash, not lots of people wouldn't have that, but for those people that do, anything above that is at risk. So if that bank goes down tomorrow, the government's only going to cover you for $250,000. So really, that would definitely be an excess.
And is that $250,000? Is that my $250,000, or if I have a joint bank account? Is it our $250,000?
It's actually $250,000 each.
Oh, okay.
Yeah.
So I can have $500,000.
Yes.
Just laying around.
Yes.
Yeah, like we all do. Hey.
Yeah. And if anything happens, the government will give you it back. I'll leave it there.
No, that's a really good point though, because the government guarantee, I think, is overlooked, and it's something that it shows that the government has a really strong opinion of our financial system, and the fact that they're willing to back the banks and say, well, if your funds aren't there tomorrow because the bank's no longer there, we'll cover that.
That's right. And I think ever since the global financial crisis as well, the banks have to increase their capital adequacy that they have. So, it's less likely to happen as it has done in the past. So your money's pretty safe in cash, is what I would say. But Teneale, perhaps we talk about some of the things that for those people that do have to have a certain amount of cash in their bank account, what are some of the ways that they can maximise their cash that they're keeping?
Yeah, absolutely. Well, first of all, I'll switch gears just a little bit about how you can extract a little bit of extra return from cash. So from money in the bank, and we're just talking a little bit about financial stability of banks, and I feel like that's a really good lead in, because there's two different ways that I can get an additional return from money in the bank. The first one is credit quality. It's a credit risk we talk about. And that's saying that if I have all of my money with a major financial institution, maybe one of the big four banks, I would expect that they will actually pay me less in interest than a bank that has a lower credit quality. So maybe a credit union, small financial institution that's providing bank accounts. And that's just saying that if I'm going to be at a bit more risk that financial institution doesn't have the runs on the boards, they need to pay me a higher level of interest. And conversely, that happens with loans too. So you might see that really good loan rates are being offered by some of the smaller financial institutions, and they need to do that because they have to attract consumers to want to put their money there. So that's the first side of it, the credit quality. The second part of it comes from what we call maturity risk, and this is one that I think is probably more well known by people. And this is just saying that if I put all of my money in a cash at call bank account, I'm not going to earn a lot of interest from it, or I shouldn't assume that I'm going to earn a lot of interest from it, because the bank's giving me the full access to have that money whenever I want it. If I give the bank more time to do something with those funds, because the bank has the ability to earn money on your money. And I think maybe if we think through the logic of that, so I put $10,000 in the bank, and what can the bank go and do with that? Well, nothing if it's at call, because they have to make that readily available to me. But if I put it in an online savings account, or I put it in a term deposit, maybe I put it in a term deposit for 6 months, that gives the bank 6 months to go and lend my money to somebody else. And maybe they're getting, 7% from a business at the moment for business lending, and they might pay me 4.5% for my term deposit or something like that. You can see the bank makes some money there, but I can also benefit from that, because I'm using maturity risk and saying the longer I give the financial institution my money for, the more interest that they have to pay me for that privilege.
Mm-hmm. So what we're saying is there's really 3 ways that you can hold your cash. So at call, in an online savings account, or in a term deposit. And you still got to think about what's going to be right for you in each of those different options with your cash, because of course one of the risks, as you're saying, with the maturity risk with a term deposit, if you need emergency cash funds and you've got it in a term deposit, you're going to have to break that term.
Yeah.
And therefore get a lower return for doing so. So perhaps, that's something for people to think about, that if you are going to need it at an unknown point in time, that might not be the best way to structure your capital.
That's right. And I think there's some sophisticated investors out there that might be thinking about different things like bonds and fixed interest. And there's a whole world of cash available out there. And that's a segment for another day. But we just want to keep it really simply to money that's at call in a normal bank account that you're using there. So yeah, absolutely right.
And I think something really important to say around how can you maximise your cash is just paying attention, because a lot of people, especially over the past couple of years when everyone's gone, well, interest rates are so low, I'm not even really looking at what my bank's giving me. If you don't pay attention, you can really be losing out. I'll give you one example. Someone had over $1 million in their bank account, and just a normal cash account, hadn't paid attention to it, and the return on the interest was around about 0.4%. So if you think about the difference of 0.4% to perhaps 4% now on an interest earning bank account, is a huge chunk. So you're really missing out if you're not paying attention to what's out there to offer.
That's right. And that makes sense even at the smaller end of the spectrum too. Even if it's just $10,000 that you're missing out on, let's call it $400 a year. $400 a year is probably covering me for what 𝐼𝐶 increased their prices by last year, or my rates, how much they're going up by. So those are some really good ways to get some wins out of cash. And if we bring this back to the rising cost of living, it absolutely correlates to go, well, if I am now in a period where interest rates have risen, I should take that advantage and I should get my money working as hard as possible for me, because I'm working hard and my costs are going up. And if I can get my cash doing a little bit of that heavy lifting for me, then that's going to put me in much better stead. Yeah,
that's absolutely right. So, Teneale, for those people that are going, well, I know that I've got this emergency number now and I've got that aside, or maybe not, but I've also got the debt hanging over my head and I can see the interest rate going up, I can see the repayments going up. What can we do to improve that in this type of environment? Because it is a bit of a double whammy at the moment. That's
right. That's exactly right. There's definitely a few things there. So first of all, I'm going to assume we're talking about something that's what we would label in the financial world as bad debt. And bad debt doesn't mean that I shouldn't have it, because it has an existence, right? Bad debt means I am not getting a tax deduction for it. It's not for investment purposes. So this is personal debt, things like buying a home, buying a car, upgrades to the family home, travels, those sorts of things. So those kinds of debt are typically the focus for being paid down first, and then they don't attract a tax deduction for me. So how can I maybe use some of the funds that I've already got to help me with that method? First of all, is to go, well, maybe we'll use an offset account. So if I've got a home loan, does my bank or the mortgage broker that I'm working with, do they give me the option to be able to put an offset account in place? And what an offset account simply does is says that if I have $100,000 on a home loan and I've got $10,000 in a bank account, if I put that $10,000 to an offset, the $10,000 worth of that loan will not have interest payable for the period that I've got the money in the offset account for. So that can be a really big interest saving, particularly when we go back to that idea of the fact that the banks are lending out at typically higher than what they're paying us. Because if I can earn even 4.5% in a term deposit, but maybe I'm paying 5.5% on a home loan. So now we're talking about what's that differential between what you can earn and what you have to pay the bank. And if you have to pay the bank more, well, maybe I should be putting some money in an offset account. Offsets are really good for the purpose of paying down the interest, but sometimes there's the disadvantages that come with it. Of if I've got it there, I might access it more quickly than I should, and I'm sure you've probably seen that, Kels.
Absolutely, and I think some of the ways that people try and reduce this being so readily available by being an at-call bank account sometimes is to actually pay the loan down and have that capital then sitting there as redraw. But not every loan offers a redraw facility as well. So
and I see that some of them, they operate more differently these days too, where they're starting to take back some of that redraw. So previously, if I had 30,000 redraw, I had that money available, but a lot of the banks have changed the way they view that and kind of go, well, over time your redraw is actually reducing at a higher rate,
That's
with
right.
loan pay down.
That's right. So you've definitely got to be careful about what you do in that space and understand how your loan is set out. But is there anything that perhaps people can do to reduce the interest rate?
Yeah, absolutely. The first thing is actually asking for something better. So instead of just assuming that the bank's got my best interests at heart, just go and have a chat with them. Go, have a look online first of all, see what the rates are looking like. Pick up the phone. There's a lot of online savings accounts that offer these introductory rates, these honeymoon rates for 3 months, 4 months or whatnot. But I've seen a lot of cases where you might see an online saving account and think, okay, that's probably going to be earning a couple of %. And then you have a look and go, oh no, it's earning nothing. And the reason for that is they took an introductory rate and then they left it there. And when it came outside of that introductory rate, it might have dropped from 1% back to 0.05, and then it was never looked at again. So just asking the bank, just telling them, look, I've got this money here. What's the best terms that you can offer me? And if they say they're going to give you an introductory rate for 4 months, just put an item in your phone, a calendar item in there, and just say, in 4 months' time, I'm going to pick up the phone. I'll have the same conversation. Yeah. They want to do what's right by you, but they're not going to unless you ask.
That's right. And I think we've actually seen quite a bit of success with that, with people going back and just simply asking the question of, can you do any better than what we've got? And the bank will then try and come to the table to give you something better where possible. So the old age story, if you don't ask, you don't get.
Yes. And it's the same is true for the lending side of things as well. So again, just ask the bank for a reduction to your home loan rate or your personal loan rate, whatever it is you've got. Mortgage brokers are absolutely worth their weight in gold because Definitely. You can get them to do all that heavy lifting for you. So, be in contact with them and go, is this what's best for me? Every time, the other thing is, the RBA changes interest rates and they do it regularly. And we've seen that through all these interest rate rises we've had in the more recent year. So each month when that announcement comes out, if you notice that the interest rate's going up, you can probably assume that your home loan rate's going to go up as well, or whatever type of loan you've got. Now, do you have to accept that full rate rise? Possibly no, because you can go back and ask the bank to do something better, or you can look at refinancing it across with another bank, with a mortgage broker. Now, refinancing has some pros and cons, and maybe you can talk about what are some of the things that people should think about when they're refinancing, Kels?
Yeah, of course. So if you're going to refinance, it's a really good way to actually get your repayments reduced, because you're effectively saying, I'm going to start again and increase the term of the loan that you've got. But of course, that's going to take you a lot longer to pay out because you're effectively starting again. And if you're, at a certain age and retirement's going to be coming in 15 years perhaps, but you've rescheduled to another 30-year repayment term, that's a bit of a risk because you don't really want to be carrying those sorts of things into your retirement years.
Absolutely, yeah. Having it paid out on the same time frame as your goals, definitely right. Great idea.
That's right.
And I suppose another thing that we spoke a little earlier on about having those emergency funds. So maybe another way of thinking about it too is, do I actually need this much cash available in pure cash funds? Or if I do have redraw that's available on a loan somewhere, on a personal home loan or something like that, could I consider that these are some of my emergency funds? Because maybe I'm looking at it going, okay, I want to have 6 months available of my living expenses, which might be $30,000 or $40,000 ready to go, but $30,000 or $40,000 in a cash account that's not doing a lot for me may be better served, like you were talking about earlier, in that home loan, in redraw, saying that I don't intend on taking it, but if I want to, it's there. So there's also something to be said for the discipline around paying down debt. And I think people work in different ways, right? So some people work really well with having cash funds there and having savings and buckets of income and all of that, and others will use those funds. And so maybe a strategy of paying down debt and thinking I can draw back from the debt if I have to, but my logic in my brain is telling me that I don't really want to do that, so I'll probably keep it there.
Yep, that's absolutely right. So really, I guess to summarise all the tips that we spoke about today is probably to assess your own emotional behaviours around money and how disciplined you are as to what strategy you might employ. Think about your emergency funds that you do need and what's the purpose and intent of that. Pay attention to both your interest rate on your home loans and ask if you can do better. Pay attention to the interest rate on your cash that you've got in your bank account and if it could be structured in a slightly different way. So hopefully you found those tips useful today, and that's us for another podcast. And if you do like our content, please don't forget to subscribe, share and like. And join us again next time where we discuss all things health, wealth and financial happiness.
The opinions of the presenters are objectively ascertainable and are not intended to be financial product or personal advice.